Universal Citizens Forks News. The annual rotation on the U.S. Federal Reserve's interest rate setting committee means its 2024 voting members lean slightly more hawkish than the outgoing group from 2023, but that won't budge the outlook for a pivot to interest rate cuts next year. In fact, plenty of analysts make the opposite argument if inflation continues to fall more quickly than expected. Fed policymakers will want to reduce rates even more than the 0.75 percentage point implied in fresh projections published last week. Friday's release of the Personal Consumption Expenditures Price Index, the Fed's preferred measure of inflation, only served to strengthen that view. Both headline and core measures cooled more than economists anticipated, bringing the annualized rates over the past 3 and 6 months down to at or below the Fed's 2% target. Over the second half of the year, the center of gravity at the Fed policymaking table has become markedly more dovish. As evidence accumulates that price pressures are easing and the labor market is cooling in the face of the Fed's rates hikes from March 2022 to July 2023 in particular. Those policymakers who had been most hawkish, including Fed Governor Christopher Waller, have backed away from their previous support for rate hikes. After central bankers held rates steady at 5.25%, 5.5% last week, Fed Chair Jerome Powell noted that the timing of rate cuts would be the Fed's next question, sending bond yields plummeting and markets pricing in rapid-fire policy rate reductions starting in March. But even if cuts come later and more gradually than that, as policymakers have since tried to signal, the direction of those bets tracks the Fed leaders' change tone as lower inflation filters through the economy. Firms that this year were able to raise prices will find it more difficult to do so next year and may need to turn to trimming labor costs to protect their profits. Signaling easier policy ahead is a bid to head off those kinds of nasty disinflationary dynamics. There is also another rationale for rate cuts next year as inflation falls. Holding the benchmark rate steady drives real borrowing costs up, so the Fed must dial back its policy rate to prevent over-tightening. If the Fed does decide to ease a little bit more aggressively, argues BMO economist Scott Anderson, it would really be because of inflation, not because of growth or a spike in unemployment. The new year will bring plenty more data ahead of the Fed's next meeting, on January 30th or 30th, including a read on the U.S. unemployment rate, now 3.7%, and just 0.1 point above where it was when the Fed began raising rates.